Hello, I'm Gary Leland, co-host of the Crypto Cousins podcast. Now, if you're not familiar with the Crypto Cousins podcast, please take a look and subscribe to our weekly podcast at cryptocousins.com/subscribe. I promise you will enjoy all the great information and content that we will provide you. Now, today I'm going to answer the question, what is Bitcoin mining? First, let's see what Wikipedia has to say about the subject. According to Wikipedia, Bitcoin mining is a record-keeping service done through the use of computer processing power. Miners keep the blockchain consistent, complete, and unalterable by repeatedly grouping new broadcast transactions into a block, which is then broadcast to the network and verified by recipient nodes. Each block contains a SHA-256 cryptographic hash of the previous block, thus linking it to the previous block and giving blockchain its name. Wow, that's a pretty hardcore definition. Unless you're a techie, you probably didn't understand anything of what I just said, huh? Am I right? Terms like blockchain, recipient nodes, SHA-256 cryptographic hash, I'm having a hard time saying them, but they're really kind of technical for the beginner who may be just discovering or trying to understand the world of Bitcoin and cryptocurrency. Now, I'm going to try and make this a little easier for you to understand, but before we get into this too deep, let me say that I really think the term Bitcoin mining is a terrible name for this process. I think people get even more confused because of the term Bitcoin mining itself, because of that term. Instead of Bitcoin mining, I wish it had been named something like block confirming or Bitcoin confirming, or maybe even something like Bitcoin transaction confirming would be okay. But the name is Bitcoin mining, and I really doubt that is ever going to change. So let's get back to the question, what is Bitcoin mining? Well, Bitcoin mining is really just a method used to record and confirm Bitcoin transactions. And by transactions, I'm talking about spending, trading, or moving Bitcoins from one person's wallet to another person's wallet. Before Bitcoin, there was always a major problem with digital currencies, and that problem was the double spending problem. You can think of double spending really kind of as the high-tech version of counterfeiting. Since digital currency is really just a file on a computer, you could copy that file and make yourself as many copies as you wanted. In other words, you could just copy the file over and over and over and over and make yourself a millionaire. Well, why stop at a million? Just go ahead and make yourself enough copies of the file to make yourself a billionaire. It's actually a lot harder to make counterfeit paper money than it is just to copy a computer file over and over and over. Now, I'm not saying you can't make counterfeit paper money and get away with it. I'm just saying it's a lot harder than simply copying a computer file over and over and over. Now, to prevent the double spending problem, Satoshi Nakamoto, who was the creator of Bitcoin, he designed a system protocol that checks every Bitcoin transaction against a public ledger. Now, all banking has a ledger, and the public ledger that Bitcoin uses is known as the Bitcoin blockchain. The Bitcoin blockchain is installed on thousands of computers all around the world, making sure no one individual or no one company can actually control it. If you attempt to spend any Bitcoins that have already been spent, they won't be confirmed by the Bitcoin miners, and the Bitcoin community will ignore the attempt to double spend as fraud. Bitcoin miners use their computers to process the transaction requests across the entire Bitcoin network and assemble a list of valid transactions. Now, to be clear, Bitcoins are not actually being sent and received like an email attachment. You're not sending back and forth Bitcoin. There are no actual files being sent back and forth, only assigned Bitcoin public addresses. Every Bitcoin public address has a matching private key too, and only the holder of that private key is capable of digitally signing a new transaction for that Bitcoin, or in other words, of spending the Bitcoin. Only if you have the private key can you spend the Bitcoin. Additionally, any request must have inputs. Inputs are the previous transactions that the sender is using to fund the new transaction. I guess you could look at it as a history of where you received the Bitcoins from. Now, if you previously received 2 Bitcoins from one person and 3 from someone else, you can use those 5 Bitcoins to fund a purchase up to 5 Bitcoins. The miners check for 2 things when you see your request to spend those 5 Bitcoins. First, they check to make sure that your digital signature proves that you are actually the owner of the Bitcoins you're trying to spend. Second, they check to make sure that you haven't already spent those Bitcoins. To make sure that you haven't already spent those Bitcoins, miners look at the public database of all the past Bitcoin transactions. Like I said earlier, that database is called the Bitcoin blockchain. Now they look at the Bitcoin blockchain to see if those Bitcoins were already used or if they are still available for you to spend. A full copy of the Bitcoin blockchain is on every computer that is connected to the Bitcoin network so that every miner can easily look at the database. I guess you could say that the miners are like the Bitcoin bankers. The miners actually confirm that all the transactions are legit and on the up and up. If the miners are able to verify both of those 2 things, they will add the transaction to their list of valid transactions that have occurred. Now, on a regular basis, a miner will be chosen to have their list of valid transactions added to the Bitcoin blockchain as a new block. And this is how the public record is kept up to date. Now, to prevent any miners from sending any false information to the blockchain, the Bitcoin protocol makes miners compete with each other for the privilege of having their list of valid transactions added to the Bitcoin blockchain. A different miner is able to write a block about every 10 minutes. Then only valid blocks will be accepted by the rest of the miners. I will now explain how that works, or attempt to at least way. A miner's block will become part of the Bitcoin blockchain if a majority of the miners agree that the transactions listed by the miners are valid and that the miner correctly guessed a special number. The number is a solution to a really hard math problem. So you might be asking, what's the deal with miners trying to solve a really hard math problem? Well, during the process of confirming transactions, all the miners are trying to solve a math problem that involves cryptography. It's a cryptographic cipher that turns one string into another string. Miners are creating a sequence of blocks that are tied to each other by including information from their last block in the next block. The process proves that the next block knew about the previous block, which proves that it came afterwards. However, that's not enough. You might know that block 4 came after block 3, but what if there are 2 competing blocks? Let's say there's a block 4A and a block 4B, and these 2 blocks that contain different transactions and the spending of Bitcoins to different places. Which one of these 2 blocks is really the next block? Well, the reasons miners did all that complicated proof of work process, or all the hard question stuff, which was a really hard math problem, is to prevent the situation from becoming a problem. The Bitcoin, the chain of blocks with the largest proof of work or block history, is the valid chain. The reason this is such a good way of deciding is that it makes it incredibly difficult for someone who wants to spend the same Bitcoins twice to create an alternative chain of blocks and to try to convince everybody else on the blockchain network that theirs is the correct chain of blocks. To be valid, the false block would need more proof of work or more block history than the other block. Since everyone else is working on the true chain, they have an enormous amount of computer power working together to create it. To beat them or to fool them, you're going to have more computer power than everyone else in the blockchain, and that is known as a 51% attack. Proof of work makes sense because work cannot be faked. So why do miners even want to mine? Why do they want to get involved in this process? I mean, they have to buy expensive computers, they spend lots of money in electrical costs. In other words, why are they spending so much money just to mine Bitcoin? Well, they mine Bitcoin because the miner that writes the new block in the blockchain has permission to give themselves a reward of Bitcoins. Remember I said one was chosen, and that one gets to get Bitcoins as a reward. So they get paid Bitcoins for their work. Now, the reward started at 50 Bitcoins per block years ago, and every 4 years, the reward is adjusted and reduced by half. Every 4 years, when the amount of reward is cut in half, it's called the halvening. At the time of this article, the reward is 12.5 or 12.5 Bitcoin per block. In the year 2020, the reward will drop to 6.25 or 6.25 Bitcoin per block, and then 3.125 Bitcoins in the year 2024. So now you know that Bitcoin mining is needed to stop the double spending problem by verifying all the Bitcoin transactions on the ledger called the Bitcoin blockchain. You'll also understand that mining computers are solving a very complicated math problem to verify they are adding the correct block on the blockchain. You have also learned that miners are rewarded Bitcoins for providing a valuable service. I hope this show has helped you understand what Bitcoin mining is and what it's all about. And don't forget to go to CryptoCousins.com for more videos, podcasts, and great information about Bitcoin and crypto. I'm your host, Gary Leland, and thanks again for joining me for What is Bitcoin Mining? This is a CryptoCousins.com production.